What are alternative investments? And how could they potentially fit in my portfolio to reduce risk and also still make a good rate of return away from the stock market itself? We're bringing in Brooke Garcia, who is a CFP, CFA, and CAIA, which is a Chartered Alternative Investment Analyst, to have this fantastic conversation with us. Listen all the way through. We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome, everyone, to Secure Your Retirement Podcast. We are super excited. We've got a very special guest today, Brooke Garcia. She is a chartered financial analyst, a certified financial planner, a chartered alternative investment analyst. So she's got a lot of knowledge, and we're super excited to have you on. So first of all, Brooke, just thank you so much for coming on and talking to us.
Thank you. I'm excited to.
So let me just kind of set up the conversation we wanted to have with you. The reason why we invited you to come talk with our clients and listeners of this podcast. So in the world of investing, when people have over the years, decided that they want to take some of the risk back in their portfolio, really what most people thought of is that let's just go do a 60-40 portfolio. And people kind of know what that means. It's going to be 60% stocks, 40% bonds. Mm-hmm. And that's supposed to reduce my risk. I say supposed to because it didn't happen a couple years ago. Bonds plummeted and everybody lost money in that area. But it did make people kind of start looking at alternatives, alternative type of investments. And that's really what I want to talk to you about today is this idea of alternative investments. And we're going to kind of dive in there a little bit. But I guess, first of all, could you kind of just help us to understand, for those that are listening, what is an alternative investment? What is a private investment? And we'll kind of go down the differences, but can we just let's start off with what that even is?
Yeah, for sure. So I'll start back and give a little bit of context. You sort of alluded to 2022 when, yes, nothing worked. Like there was no place to hide. For many years before that, the world of private markets had been evolving and growing because of institutional money. So endowments and foundations and pensions were looking for a place to find good investments, and bonds were doing nothing. They were at zero because the Fed kept interest rates so low for so long. And so to sort of supplement some of that return stream that the institutions weren't getting, they were going out to the private markets. So traditionally, rather than having like a bank go out and make a loan, banks pulled back after the great financial crisis. And so you started to see all of these other asset managers go out and start making the loans that the banks weren't making. So they're going out to a company and they're saying, you're not going to get it from a bank, you're going to get it from us. We're going to have custom terms to this. It's still debt, just like it would be on the public bond side, but it's not publicly traded. It's a direct investment between an asset manager and the company that needs the funding. Private equity is also like lots and lots of companies are rather than going public, they're either starting private and staying private for a long time, or you see leveraged buyouts where public companies, private asset managers go out and they buy these companies and they take them private. So that's kind of when you there's a lot of other ways that you can sort of have private market investments, but basically it's something that's not traded on an exchange. So you can't go out and buy or sell the stock. It's something that traditionally has been something that you have to hold for a very long time until you find somebody else to buy it from you. Or in private equity, for example, the private equity firm takes the company public.
Yeah, so, and I think I read this stat, and my number is wrong here, so whoever's going to fact check me that's listening, and just realize I know I'm wrong, but I think it's like 20% of companies or successful companies, 20% or less, are actually publicly traded, and maybe even closer to 13%, right? So the stock market that has trillions of dollars in it, only 13 to 20% of is of the world's best companies are in the stock market, right? That means 80-ish% are outside in this private space. And I know a big one that comes to mind, and everyone has been exposed to it, is OpenAI, ChatGPT, right? That's a private company, but I think most people would say that's probably one of the fastest growing and one of the most important companies in the world right now. And so I want access to that. You got some of the best growers that are in a place where you just don't have access unless you go down this private route. So I think one thing, help us understand a little bit more around, well, why would anyone start to consider private investments into their portfolio rather than just doing the traditional stock bond mix? And then we'll get into a little bit more of like, well, what do we need to think about here? How do we properly structure this? And what's the right, percentages of allocations toward this really cool investment side with that's shown tremendous growth, but also there's always going to be issues. There's no perfect investment. So let's start there, Brooke. Help us understand, why would someone ever consider bringing this into their portfolio?
Yeah. So, and I think just on the point that you made, there are a lot of, especially like sexy names, right, that are not publicly traded. And so it makes a good story. So, I mean, be aware of that for sure. But I would say there are a couple of different reasons why somebody might consider private markets as part of their overall portfolio. One is that they sometimes have the potential for higher returns than you can get in the public markets. Traditionally, that has been true. There's this thing called a liquidity premium, where basically you expect to get compensated more for locking your money up. And as I mentioned, you can't buy and sell those shares easily, so you have to just hold them. And so for being willing to hold that and lock up some of your money, theoretically, you should be compensated more for that. So one thing is that potential higher return. Another thing, and people will debate about whether this is good or not, but from an investor experience perspective, in public markets, you can go out and you can look at the stock price any day. Like multiple times during the day, you can see how the value of your stock is changing. You feel every bit of that if you're watching your portfolio very closely, and a lot of retirees and pre-retirees do. You can't do that in private markets. So you can call it volatility smoothing, you can call it a number of different things, but because you're not seeing the value of those companies that you hold or the debt that you hold change on a daily basis or even a monthly basis in some cases, it feels like a smoother ride. You don't feel the volatility that you do feel in the private markets. And for individual retail investors, like that can help you feel more confident when the public markets specifically are very volatile. Now, the caveat to that is that just because you're not seeing the value change doesn't mean it's not changing. Ultimately, those companies the value of it is what they can go out and they can sell something for. But it does help with sort of that investor experience, feeling a smoother ride. And that kind of helps tamp down the unease that can come with volatility in a normal portfolio.
Yeah, I know there's an analogy that I've used in the past that's really helped people kind of understand this illiquidity aspect of private investment. So take your own house, right? Your own house that you live in, and if you said, I want to go sell this house today, well, you could try to do that, but you would get it ready for sale. You would engage with the realtor in most cases. You would list it, and then eventually you start showing the house. Eventually you get a contract to buy, and then they go through their due diligence. And all these things happen. So in most cases, when you sell the house, you don't sell it on day one. You don't get that check on day one. There's a whole process and timing before you actually get the cash. And so when I tell people that, they start to understand, okay, so it's not going to move every day, right? Like my Apple stock would. And it may only move monthly or quarterly, right? And so that is something that is like a good or a bad thing, right? If I like looking at my money every single day and this one piece isn't moving, well, how do I know how it's operating? But it is a different piece. But the advantage of that is, well, it kind of puts you in this mode of, I'm not paying as much attention, which can be a blessing sometimes, as well as it kind of provides this ability for smoothing, I guess. Or, well, can we talk a little bit about what's the word that we use? Correlation, right? That's a big term. So explain correlation, and then how private investments and alternatives could help decorrelate or de-risk the portfolio a little bit, and in terms of volatility, but as well as just different types of investments.
Yeah. So correlation, just simply put, is how two or more asset classes move in conjunction with each other. So if my stock goes up, does my bond go up the same? Does my bond go up less? Does my bond go down? And so generally, when you're trying to create a stable portfolio, you want to combine a series of uncorrelated assets together to provide some stability. And so that when, like, 2022 is a horrible example, but theoretically, your stocks and your bonds are not super correlated with each other. So when the stock market is maybe struggling a little bit, your bond portfolio is holding up and is providing some of that stability. I think when you talk about, like, terminology wise, you need to be kind of careful because alternatives can be a lot broader than what we think of in private markets. So private markets, you're thinking private credit, you're thinking private equity, maybe infrastructure, maybe farmland, things like that. Or some of the more fun, like sports teams or things like that. Alternatives, though, when you think about what you're really looking for is a diversifier. So gold is a common kind of thing used, asset class used as a diversifier, right? Private markets can also provide some diversification. Now, there's still going to be some correlation. So we look at it on a scale of 0 to 1. 1 is perfectly correlated, they move in lockstep. 0 is not at all. You can have negative correlation, right? There is still going to be some correlation between private markets investments and public markets, but especially because of that sort of delayed marking of the assets underneath and some of the delayed reporting, you're definitely going to see that correlation it's going to provide some correlation, some like diversification benefits essentially. So that can definitely contribute toward having just another piece of your portfolio that isn't in lockstep with your stocks. It isn't in lockstep with your bonds.
Yeah. So let's talk a little bit about maybe some things that people need to know when it comes to these investments. Mersh just kind of walked through a little bit of it, and that is that if I want to sell Apple, I can, at a click of a button, sell my Apple. When I buy into a private investment, there are things I need to know when it comes to liquidity. So could you kind of walk us through and give us the landscape of what I need to know about when it comes to liquidity in a private investment?
Yeah. So it completely depends on the vehicle that you're using, right? So I mentioned these endowments and foundations, these institutional investors that have been investing in private markets for a long time. The process that they go through to get invested is a lot of paperwork. It's complicated paperwork. And then they basically hand over their money and they say, here's the amount of money that I promised I was going to give you, and I'm not going to see any of it back for 10 plus years, maybe more. That's a traditional like drawdown type of vehicle. Those still exist today. And if you have the right kind of net worth, you can access those if you wanted to. There's been a lot of innovation over the last several years and proliferation of different types of vehicles that can make it a little bit easier to access those. So interval funds, tender offer funds, those are very common, becoming more common today. In those, you have some limited liquidity. So you're not necessarily, and I'll be talking generally about evergreen vehicles, which means that it's not a one specific fund that sits for 10 years, you get your money back, that fund closes, they open up fund 2, right? I'm going to be talking about an evergreen structure where it's the same fund that just always continues. But you go in, you go through a subscription process. There can still be paperwork. There are some technology providers available to kind of help smooth that process. But when you go into, say, an interval fund, for example, most of them will say, okay, you can subscribe to this monthly, for example. You can give us your money monthly. You're only going to be able to get your money out on a quarterly basis, and it's limited. So we're going to limit what you can get back to, say, 5% of the fund. If a bunch of people all want their money back all in the same quarter, they're going to say, we are capping it at 5%. So you wanted 100,000 back. We're going to pro rata that 5% across everyone. So you wanted 100,000, you're only going to get 50, for example. So that's definitely a consideration. You need to know that when you put your money into this, you can get it back. But one, it's designed to be a long-term investment. It's not designed to be something that you're going to pull from on a regular basis. Think long-term capital appreciation, that diversification benefit. This is something that you're going to lock in for a little while. But you can get it back. It just depends on the structure of the vehicle that you're investing in. That's most common. Tender offer funds are similar, but they are not required to provide liquidity like on a quarterly basis. It's sort of subject to board approval, so that's another thing to consider. So the liquidity and what you're sort of giving up for the ability to be able to redeem on a quarterly basis, assuming that's the fund terms, is you are going to see a little bit of erosion in, like, they're going to hold more liquid assets. Those funds are going to hold liquid assets so that they have the ability to provide redemptions on a quarterly basis, which means that you are going to potentially, I mentioned earlier, the higher return profile that these have historically been able to provide. You are going to see a little bit of erosion of that because you're giving up a little bit of that juice for the ability to have some liquidity when you need it on an intra-quarter basis.
Yeah. I just think that, so in my mind, this is the way I think Merce and I think about this when we're designing a portfolio. If we're going to put alternative investments in the portfolio, because of that liquidity side of things, we're not going to go put 60% of the portfolio in alternative investments, right?
Position sizing is absolutely so important when you're making a decision about these.
So we've kind of put it at a cap right now of 20%. So we say, hey, if I got a person who's going to put, they got a whatever size account they've got, we don't want to put more than 20% in that type of investment. That means they've got a ton of liquidity. And so this idea of this liquidity is not a big deal. And I want to go back and just reiterate what Merce said. I mean, if I buy a house, I give up some liquidity on that money, but I can get it back. I'm going to have to go through a process.
Yep.
And I don't want to sell my house rapidly like that. So what are some cautions that people maybe need to think about when it comes to these type of investment? Like, okay, somebody goes right now, they're listening to this and they go, oh man, this sounds cool. So they start Googling or Chat GPT and alternative investments, private investments, and then they find about these different, public funds and all these different things they can go do. Like, give us some landscape of maybe some cautions that somebody might want to think about before they actually go out and say, I'm going to do this.
Yeah. Well, one is what you just said. Position sizing is super important. There are some people out there in our industry that would advocate for like a 50% allocation to private markets. That's insane. And I would tell him, the person that I'm thinking of, I would tell him that to his face. But yes, I think position sizing and 20% is probably a good bogey, maybe a little bit less. I mean, it's all dependent on the individual situation of the client, how comfortable they really will be with actually like locking that up. But I would say outside of position sizing, who your management team is super important. So in private markets, way more so than in the public markets, there is a huge dispersion of returns between the best performing managers and the worst performing managers. Like, it's a very wide dispersion. And so going with someone who has gone through a deep due diligence process, professionals have evaluated it, and I think that this is going to become increasingly more important because there has been so much money that has flooded into the private market space over the last couple of years. Every other day, an asset manager is coming out with a new product that's private markets focused. All of that money has to find somewhere to go, and they have to find good investments. And if they have, they're attracting cash, but there are not great investments out there to pick from. They have to pick from less ideal options, right? Which will erode the return over time. And so I think that finding a really solid manager with a really solid track record, because my team does evaluations of private market managers all the time. And we have an extensive due diligence process that we go through. The management team is oftentimes like the most important thing about a potential investment. Do they have a track record working together? Do they have a demonstrated record of success? Do they have the resources necessary? Do they have the name and the size necessary to be able to go out and get good deals? So those are important. And I would say that for the listeners here, the way that they figure that out is through you all. Being there to help pick some of those. There's a lot of garbage out there. The whiskey barrel investment or whatever, like, no.
Yeah. I just want to say this real quick. I mean, that's why, Merce and I, we wouldn't be able to do all that vetting either. So that's why, we want your team as a part of our team. And so that's why we've partnered with you guys, because we know that you've got a good team of people that's what they do. That's what you guys do, is go look at these things, so that when we do make an offer or bring up an offering to our clients, we can say, no, this has been vetted from the top to the bottom. It's been looked at and analyzed, so we know that what we're putting in front of you is a good investment. Yeah. So we do appreciate that. Anything, Merce?
No, I would just say, I think there's good reason to understand this topic, as I kind of talk to listeners here. It sounds sexy, right? Getting involved with some of the fastest growing companies in the world, the potential for better return, de-risking or decorrelating a little bit, or having this differentiator in your portfolio can be nice. I mean, this is what the ultra high net worth has done for the longest time. This is what Harvard's and those endowments and all this stuff they're doing, and there's a track record for success here. But it's very important also to understand, the limitations and the cons of any investment.
I think that's why it's an advantage to have you all on their team, because you can help make a decision about, okay, does it make sense, first of all, in this portfolio? 2, how do we size it? 3, what do we pick? Because there's a lot of options out there. Do you go out and you pick a private credit fund? Do you go out and you pick a multi-asset solution that can kind of go anywhere and is really flexible? And they have the advantage of working with you all to help figure that out.
Right. So to close this out, what I would say, and we say this all the time to our clients, which is Roth conversions, right? That's the big hot topic right now. Everyone's worried about taxes and everything like that. What we say is, should everyone do a Roth conversion? The answer is no. Right. But should everyone look at that year by year? Absolutely. You should always be evaluating that potential opportunity. So same thing here, right? Should you have private investments in your portfolio? The answer is no, but should you be looking at it, right? It's not a definite that I need this in my portfolio for success, but is it something that could fit into my plan? Well, I need to evaluate that. And so if if your advisor that you're potentially working with already doesn't talk to you about this, and they're not talking about it, maybe they don't understand it, right? It's a very complex space. And if you want to learn more about this, we're always happy to have that conversation with you. Simple way to do that is go to our website, pomwealth.net. And from there, you'll be able to schedule a phone call with one of our advisors, and we're happy to kind of educate as best as we can on this and see if it could be a good fit for you.
Thank you very much, Brooke. We appreciate you coming on.
Thank you.
We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.